Hello guys, good morning. Please, if you can hear me, I'd like you to comment on the comment section. Let me know that you're hearing me this morning before we quickly start running through our webinar, our live stream today. Okay, today we're going to be discussing strategy session. If you can hear me, just comment on the comment section. You can drop your favorite emoji. Let me know that you can hear my audio before we commence our analysis. Thank you so much for joining us, guys, every one of you. All right, so I believe you guys can hear. Some of you have started dropping in their comments that they can hear me loud and clear, loud and clear, loud and clear. Then we go straight to the point. All right, so I believe you all can see my screen right now. And if that's the case, make sure you share this video to someone you like to learn from what we are doing as well this morning. If you have someone you know who is a trader and you like the person to benefit from what we're doing, do not hesitate to share the link with such a person. Alright, guys. So today I'm going to be taking you through a strategy session. Remember that in yesterday we had an introductory session on what a proprietary firm is and how to leverage on proprietary firm to scale up your trading equity. That was our topic of discussion yesterday. However, today I promised that we're going to run through a strategy session today where I'm going to be showing you a few approach to the markets and how you can consistently almost catch something in the marketplace between 30 to 40 pips on daily basics. Okay guys, so that was our discussion yesterday. So today we will also be discussing about how to do that using price action, using institutional trading concept, or you can call it smart money concept. Alright guys, so today we're going to be doing that. We're not going to take a lot of time to be able to do that. It's just straight to the point because I do not intend to take much of your time even today. So quickly, the first thing we would like to study or to learn how to do is that we need to learn how to do proper top-down analysis, top-down analysis, okay, by studying what institutional order flow is, or institutional order flow of the higher time frame. Then we need to learn how to take entry signatures, and we're going to be considering just 3 entry signatures. The first is we'll be considering market structure for our entry signature. All right, the second entry signature is we'll be using swing points. Then the third is we'll be using displacements and return to fair value gaps. Then the last is, okay, I'm not going to discuss about the fourth, so let's just do three, it's fine. Okay. So guys, let's take it. All right, some of you are saying you can't hear me. Is it true that you cannot hear me? What is going on? Let me know that. Let me know if the challenge is from me or from you. You can't hear me. Why is it so? I mean, can't understand why. You cannot hear me. Oh, sorry. I think it's from me. All right, some of you are saying you can't hear me. Is it true that you cannot hear me? What? Can you hear me? Just drop it in the comment section. Let me know that you're hearing me. Good. Yeah. Someone said I just need to speak louder. Okay, and I need to speak louder, right? So no problem. My volume is low. Amazing. All right, so these are the things we are going to be looking at today. All right, we are going to be learning how to do proper top-down analysis by simply understanding what the institutional order flow of the higher time frame is, because institutional order flow is how the market literally drives itself from one point to the other. When you see the market going up, it has a specific reason for why it's going up, and when you see price action going down, there is a specific reason why the market is going down. What do I mean? I mean, if the market is in a bullish move or bullish trend, there is a specific reason why the market is going up. It's not random. It's not just random. When you see the market going down, all right, it has a specific reason for going down. All right, there is something specific calling price action to go down. It's not random as well. That is what we are going to be studying. It's called institutional order flow. All right, unfortunately, we do not even have enough time to be able to digest quite a lot of things, but my goal is to just show you one or two things you can use to fish out something for yourself in the marketplace. Then the next thing is simply entry signatures. We need to understand how to take entries, when to enter, and then using what pattern of entry. We are going to be using market structure, swing point formation, and displacements plus return to fair value gaps. All right, that's what we'll be using. So what is institutional order flow? Institutional order flow is how the market is delivered on the higher time frames. Okay, and how do we, or where do we study institutional order flow? we study institutional order flow from the higher time frames, because the higher time frames are the main driver of price action, and the institutions will always position themselves on the higher time frame. Okay, because that's where the liquidity is residing. When you hear liquidity, we are talking about money. That's where the volume, that's where the money is residing, and that's the only reason institutions will move from one point to the other, because there is money residing where they are, okay, on the higher time frame. So how do we study institutional order flow? We study institutional order flow by simply using three indices. Number one, we need to ask ourselves, where is the market, or where has the market traded from? Where has it traded off from? Where is the market currently, and where is the market heading to? Where has the market traded off? Where is the market currently? Where is it trading to? Where it's trading to is called the liquidity pool, or the drawn liquidity. Do you understand? Where it's trading to is called the draw on liquidity. All right, so where has the market traded off? We are using 3 or 4 indices of price action. We call it elements of a trade setup, or we call it interbank price delivery algorithm. We are trying to study price from the perspective of 4 things. Has price traded off from a premium or discount region? That's the first thing we need to check. Secondly, I said the first is, has price traded off from a premium institutional reference point, or then secondly, is price, where price is currently, is price in a consolidation? Is price in an expansion? Is price in a retracement, or are we in a reversal? These are the 4 things you will need to study the current institutional order flow. We have the previous order flow, where price has traded from, all right, whether from a premium or discount level. Then we have current institutional order flow, where price is currently relative to consolidation, expansion leg, retracement, or reversal. Then where is price trading into? That would be the drawn liquidity. That is the liquidity pool. So quickly, what we mean is that when we say price is in a discount or premium region, is that when you have 2 swing points between 2 levels, for example, 2 swing points, as in this case, okay, 2 swing points between a high here, for example, and a low here, right? You can see between the high here to the low here, this is a trading range. This is the current trading range that we are. All right, when you use your Fibonacci to measure between the high to the low, it gives us the trading range between 0 to 100. Okay, you can see 0 to 100. That one there represents 100. Then 0.5 represents 50% of that range. Okay, what we have here is we have defined a specific trading range. Everything above 50% is called premium, and anything below 50% is called discount. Okay, so we sell a premium market and we buy a discount market. So if we are in a discount, that means we are looking to buy discounts into premium. In a bearish order flow, we sell it from premium, and in a bullish order flow, we buy what? We buy from discount. In a bearish order flow, we sell from premium. So here, if we are in a bullish order flow and price is in a discount, that means we are going to buy this guy into a premium range of the higher time frame, the daily, the weekly time frame. All right, so that's what it simply means. Previous institutional order flow. Where has price traded off? So sometimes you would see that price has traded into a premium and just left the premium, retraced back. Okay, so price has traded off a premium market, went back to retest premium, then we will start selling into a discount. What is the current institutional order flow? I said we are using 4 things: consolidation, expansion, retracement, or reversal. Consolidation is when a market is within 2 specific range. That means it's not moving. All right, accumulation, something like that, is not moving. Price is in a range. When you see something like that, what the institutions are doing is that they are accumulating contracts before they deliver price. So sometimes they will take out the high of the consolidation or low of the consolidation, then they will create a clear expansion leg. You see this swing impulsive move, that is an expansion. I really hope that you're understanding what I'm saying. That's an expansion move. This is consolidation, expansion here, then retracement into the previous range that was created here, retracement into internal range inefficiency. All right, that's what they are doing here. Then what are you expecting? So if price is in an expansion, you don't sell an expansion. You wait for price to retrace or reprice into the previous created range. Then you sell again from that internal range to create a new expansion leg. Then if you have sold this, you need to still wait for retracement before. If you missed all of this, you need to wait for retracements to still retrace into internal range inefficiency. Between the high to the low, above 50% is premium. So you sell again. You see that? So what are you doing? This is consolidation. So what you are trying to study in current institutional order flow is, are we in a consolidation? Are we in an expansion? Are we in a retracement? If we are in a consolidation, we need to wait for price to create a clear impulsive leg before we know the direction of the market, because we are not trying to chase price action. We are waiting for the institutions to show us where they are going to go to, then we follow them. That's how we make money trading as smart money traders. Okay? Then we wait for price to retrace into internal range. Then we still short that internal range, okay, because this is a repricing into a premium or equilibrium, because you can sell at equilibrium or above equilibrium. Equilibrium is 50% of the entire range. Then we sell again to create a new expansion leg. When all of this is delivered, remember we said that it's not random. It has a specific reason why it's doing what it's doing. Let's assume that this is the objective. This is the sell-side liquidity pool. Immediately the institutions deliver into their objective. Okay? Once they deliver into their objective, then we can start seeing reversals happening, because now they have achieved their target for going lower. You now see a shift of market structure happens. What are you now? You are in a reversal market condition. Price is going to start reversing into other levels. You see that, especially if the order flow has changed. I really hope that this is really explanatory. If you do not understand, you may need to rewatch the video after we're done with the session. You may need to go back and rewatch this. Remember, we all started from identifying the trading range, premium and discount, and we said that when you have a trading range between a high and a low, 50% of the range is called equilibrium, or 50%. Above 50% is premium, below 50% is discount. When we are bullish or in a bullish order flow, we buy discount markets, and when we are in a bearish order flow, we sell a premium market. Then when we want to understand the current institutional order flow using 4 indices of markets, of market price delivery, we call it interbank price delivery algorithm, which is consolidation, expansion, retracement, and reversal. Then I explained what this means. I said when price is consolidating, it's between a trading range. It's in between a trading range. Okay, and when this is happening, one thing you will see is that, or the reason why they are doing this is because they are accumulating contracts. All right, they're accumulating enough contracts before they start delivering. So when we are in this market condition, we do not do anything. We wait for institutions to create a clear expansion or impulsive move to the upside. Not to the upside. We will wait for them to create a clear impulsive swing to create that leg of expansion. Then we join them when they come back into the previous created range. We sell from there. And that's how we keep selling expansion legs. When the objective is delivered, then we can clearly anticipate a reversal to unfold in the marketplace. Okay, another thing to take note is that most of the times when price is in a consolidation, the first move will be a manipulation, or we call it Judas swing, right? The first swing will be a manipulation to manipulate retail, to induce retail traders to take long positions because they are trading breakout strategy. They are doing breakouts. So at the time price breaks out of this range, they start to buy price action. At the end of the day, price is going to reverse on them, take out all their stop losses, and continue to go in the opposite direction. So that's why you should be careful of the first leg out of a consolidation. It is most likely going to be Judas swing or manipulation to induce retail traders to take the opposite side of the market. All right. This thing is seen on all time frames. On all time frames, you would be able to see premium and discount and all of these things that I mentioned, I just showed you. So it's advisable that you go into the market, go and do inside study, see it happening again and again. So when we know where the current institutional order flow is, the next thing is, we said, where is it going into? Where it's going to go to, it's more important to you because that's what you are trading. You are trading the drawn liquidity. You're anticipating price to trade into those levels. Okay, so that means that we need to know what those levels are. They are called the liquidity pool. All right, guys. And a liquidity pool, there are two types of liquidity. We have liquidity residing in form of external range liquidity. That is liquidity residing above old highs or outside. You have liquidity in form of internal range liquidity residing within a range in form of inefficiency. All right, so whatever is the case, what we want to do is that we are looking to identify where the next drawn liquidity is. The next drawn liquidity can be into an internal range or into an external range. Okay, external range liquidity are two types. We have buy side liquidity and sell side liquidity. Sell side liquidity resides below an old low. You see it residing below an old low. For example, if a low is formed here, if price is trading, it's going to trade into that old low because that old low has sell side liquidity pool residing below it. Or when you have relative equal lows, the lows are not really very equal, but they are relatively equal. You see that? So all of these, we call them relative equal lows. Okay, so when you are selling into that level too. This is relative equal low. This is also sell side liquidity pool or equal lows. The lows are very equal. Do you see that? So when we are selling this time around, we are selling into that equal low. Institutions will come into it. This also is sell side liquidity pool. I think it's well explained. Then when we are buying, where are we buying into? We are buying into buy side liquidity pool, like I mentioned, relative equal highs like you see here. So let's do this. This is relative equal high. Okay, you see the institutions will trade into that. This is an old high. You see, we traded into an old high. And then when we have equal high, they will also trade into equal highs. You see that? This is drawn liquidity. That's how we identify the draws on liquidity. All right, that's drawn liquidity. So that's how we know where institutional order flow is. All right, so quickly let's do hindsight study just to know where order flow is. Now look at this. You can see that at the time price created this old low, price traded back into something we can call rejection block. Then price started to go down, creating bearish order flow, because we see the monthly candles taking out previous monthly lows, respecting the highs. That's a bearish order flow on the monthly time frame. When the monthly candles are taking out previous monthly lows, that is a bearish order flow. When the monthly candles are trading above previous highs of the monthly candles, that's a bullish order flow. Okay, so you can see from here, where is the drawn liquidity? The old low here was the drawn liquidity. Price traded into it. Then remember I said when we achieve an objective, we are more likely to see a reversal happening in the marketplace. Like I showed you around here, I said when we hit this, reversal started to happen back into the range. So did you see that right here? As the objective was delivered, reversal started to happen. Price went up again. Price traded up, right? Just a minute. All right, so look at what happened after this was delivered. Price reversed into the previous created range right here. Okay, so if we were here, we would have said that the current order flow as at the time, I need my chart to be very clean, please. So look at what happened. Price created a bullish order block, traded back into fair value gap, started to trade into the previous breaker block right here. Okay, so the thing is, I know many of you now are like, we are confused because this is the first time you are learning this type of concept and you do not even understand what I'm mentioning. Please take out time, go through the videos on the channel. I think I took out time to explain 7 institutional reference points. If you go through the videos, you are going to see the 7 institutional reference points on this channel. Study it and it's going to give you clarity on all the terminologies that I'm using and what they look like. Okay? And what they look like. So, having explained that, current institutional order flow, the drawn liquidity, I have already explained how to identify that, right? So, once we know what the order flow is, once we ascertain that we are bullish or bearish, look at this. After a while, we traded into a higher time frame breaker block right here. What are we, or where are we now? We are in a bearish order flow on the monthly time frame of the GBP USD. Okay, we are in a bearish order flow on the monthly time frame of GBP USD. That's where we are now. That's where we are. Just look at this. Price traded from a reversal after we took out the sell-side liquidity pool here. We priced into a premium level between the high to the low here. Above 50% is premium. Price traded into breaker block in the premium region or premium level. You can see that. And now price has formed a swing high. Swing highs and swing lows are rejection patterns or reversal patterns, where you have the middle candle having the highest high with two candles by the left and right, okay, having higher lows. So you can see this candle here, on this candle here, the middle candle has the highest high. That's a reversal pattern. See another one here, 1, 2, 3. The candle here, the middle candle had the lowest low with two candles by the left, one by the right. You can see one by the left, one by the right. The middle candle had the lowest low, and then all of a sudden we reversed. When you see it here, we're going to go down heavily. Okay, guys? So that is a reversal pattern. So when we do this on the weekly time frame, on the monthly time frame, then the next is we go down to the weekly time frame. Okay, we go down to the weekly time frame, and on the weekly time frame as well, we'll be looking to refine the monthly levels that we outline on the weekly time frame. Just a minute. So we go down to the weekly, and on the weekly time frame, we are also going to be identifying institutional order flow of the weekly time frame. All right, we need to see the weekly candles taking out previous weekly lows, and we need to see the weekly candles creating that expansion, retracement, expansion legs, retracement, expansion legs, retracement. All right, then we just go down to the daily time frame, and on the daily time frame we are paying attention to market structure. What is market structure? Market structure is simply price forming higher highs, higher lows in a bullish market structure. Notice that all the lows respect previous lows. Okay, the new low doesn't take out the previous low, but the new high takes out the old high. The new low doesn't take down the previous low, but the new high takes out the previous high. That's a bullish order flow or market structure. If you are bearish, you'd see that it's forming lower lows, lower highs, lower lows, lower highs. New lows takes out previous lows or old lows. So you can make money by simply trading from the daily time frame. Okay, because what I'm teaching you guys is simply day trading. Okay, I'm simply teaching you guys day trading. And what you will need more is that you need to come down to the daily time frame and know what the current market structure of the daily time frame is. When we come to the daily time frame, we are looking to identify price forming that higher high, higher lows, or lower lows, lower highs on the daily time frame, and that's what we'll be using to form the basics of our analysis. Okay, guys. So that is what we'll be using to form the basics of our analysis. Just a minute. Then once we do that, so you can see that on the daily time frame we've been bearish, price has been forming bearish market structure. Look at this: lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. lower low. What happened? What just happened?